Okay, welcome. We'll start our lesson 3. Today lesson will go through LO3 learning outcome 3, which is about be able to interpret financial statement and make justified recommendation either to invest or not invest, what is the actual progress of the company, either to lend or not lend money. So we'll go through financial ratio. My name is Anjum Satar and my email address anjum@ukversity.co.uk. If you have any question, please drop me email. I'll try my best to get back to you as soon as possible. We'll start. So we'll recap first. Previous lessons we discussed about sole trader, we discussed about Partnership Act in 1890, we discussed about limited company, we discussed charities, we discussed IAS 1, we discussed IAS 16, we discussed IFRS, International Financial Reporting Standards, we discussed how many types of financial statements. So all these we discussed in the previous lesson. So today lesson is about the financial. So always good to be when you will start any activities, try to reflect. Guys, just think about how much knowledge we have about limited companies and financial statement, what we know about. So yes, please, 2-3 minutes, just reflect what you think. Write down, please. Count your knowledge. You know the financial statement, how many types. You know how we can prepare it. You know the legal requirement of the Company Act 2006, and you know the audit requirements. Okay, we'll move to next. Okay, today lesson we have indicative content, what we're supposed to be learn. We'll go through calculation and interpretation of these ratios: liquidity, profitability, working capital, efficiencies, resource utilization resources. So these are important ratios. Interpretation of accounting ratios, comparison with similar companies and industries. We can as well. We can justify useful of these ratios, and we can look around these international accounting standards, gaps, and various IFRS 102 and 105 about small, medium size, and micro companies. That's all will be in our discussion. Today lesson is our assessment criteria: evaluate, accounting record, make justified recommendation. Hello, morning. Hello, good morning, Haki. Okay.
Good morning, and I'm sorry to late.
No, that's fine. Okay. We'll start. So today we'll go through LO3. We are discussing about how many assessment criteria we have. 3.1 evaluate accounting record. 3.2 justified recommendation improvement. Usefulness of financial ratios and international difference. Financial reporting different standards we can include to address these learning outcomes. Okay, so first we'll FRS, Financial Reporting Council. These has issued a number of changes: micro, small, and medium, large. So micro companies, small companies, and medium large companies, according to the Financial Reporting Council, has issued various changes at the lodge in the response of implementation of new EU accounting directive. So in the light of EU laws, so new accounting standard FRS 102, financial reporting standard for the micro entities regime, new section 1, small entities FRS 102, financial reporting. These are all the standard related to small companies and the UK. So the adjustment. So other changes necessary: continuous compliance with the company laws, and annual review 101 reduce the disclosure of the framework, and these changes actually start from the 1st January 2016. Implementation FRS also available an overview of the financial reporting framework. We describe the financial reporting framework applicable accounting period from this period. So these are all the changes happen in these standards to make more transparent and embedding into UK all the EU directives. Okay, FRS 102, FRS 105 micro. So what is the definition of micro company? Micro entity is contained in the section 384 and 384B of the Company Act 2000. To qualifying condition, turnover 632,000, balance sheet is total worth of 316, and number of employees 10. Financial reporting option FRS 1 year only. Yes, that was. So the section 1 of FRS 2 is EU adopted IFRS. So FRS 1. So these are all the legislation, those we can look around and embed, when we're talking about the micro companies. Any question?
No, that's fine.
Okay, then further we can look around. Okay, welcome, morning. Okay, let's please. Next, we are discussing about the the user of financial statements. So we learn about 4 types of financial statement we prepare in account: statement of comprehensive income, statement of financial position, statement of cash flow, and statement of change in equity. So here we're looking when the interpreting the financial statement is important. Certain we need to be look around who are the user of the accounts and what information they need. The shareholders and the potential investor, they really primary concern of receiving adequate return on their investment. That's why they need to be look around the financial statement. They are really interested in the stability and the liquidity of the business. Okay, please, if you have any question, you can ask. Suppliers and lenders, they have, of course, they lend the money. They're looking the financial statement to make the decision either to give the credit or not give the credit. Financial institution implies also looking, the company will be earn more money, their job will be secure. So that's why the financial statement are the crucial, and we can use the ratios to interpret the performance. So ratios are simple calculation based on the traction in the set of data, 2 numbers. Yes, all is a ratios, so we can calculate these ratio. Financial ratios is a crucial, but financial ratios is not before. Okay, so next we're looking now.
I am already admitted, right?
Hello, can you hear me now?
Yeah, all right. Thank you. I can hear you now. Thanks.
Okay, brilliant. Welcome. Okay, so today we are discussing about the financial ratios and the statement of different financial statements. We
Yeah.
discuss about up to now statement of comprehensive income, which is also known as profit and loss. We have discussed statement of financial position, which is balance sheet, show the asset, liabilities, and equities. And we discuss about statement of cash flows. Uh, Cash flows have normally three activities: uh, operating, investing, and financing activities, and statement of chain in equity, where we can see how much return earning, how much earning we have during the year, how much dividend, how many shares. So all these statements we have discussed already. So today we are looking the ratios, and the ratios is quite crucial to make various financial decisions. So, but the ratios we don't need to be relied 100%. Is it ratios tell everything? What do you think? Can we
Well,
rely on ratios? Yes,
ratios might not disclose everything. There are limitations to it.
there are the limitations. Well done. So we heard about creative accounting. Yes.
Mm-hmm.
What is creative accounting?
I don't know. I don't know what it is, but
Okay. Look around. We know double entry, debt click. Yes. What goes on the debit? What goes on the credit? Expensive goes on credit.
mm-hmm.
Yes. Asset goes on credit. Okay. I'm saying we had a new interior or something within a car, and due to this car value increase. Yes, or maybe we
Mm-hmm.
have a CNG, yes, gas kit in a car. So what do you think, we'll treat as an asset or we treat as an expense?
Is it an integral part of the car, or is this an addition?
Let's say because we have a CNG, yes, extra kit, extra instrument installed within a car.
Yes. All right. If it is an extra instrument in the car, it should enhance the functionality of the car, so it should be an asset.
It should be an asset. Yes, so here can be a sometime gray area. Yes.
Mm-hmm.
So some people maybe think we can put as expense. Yes.
Mm-hmm.
Some maybe we think we can treat as asset. Asset it, if anything, which flow the future economics benefit. Yes.
Mm-hmm.
Due to the installation is treat as asset. Otherwise, if don't increase the efficiency of the car, it should be treated as expense.
Yeah.
So, if all we can under and overstate these things are put in different, principally is wrong. If it's expense, it should go in the profit and loss. If it's asset, it should go. Yes. So maybe
Yeah.
the financial ratios represent totally wrong things. Yes. That's
Mm-hmm.
one thing. And other thing, if we done the asset, this the instrument installation in the, let's say, October, and our year end is the 31st December. So our asset not really we hold it for 12 months. So when we comparing against the profit return on asset, so asset is we only hold it 2 months, but we checking asset values against 12 months profit. So that's maybe it's not a right criteria as well. Yes. Other, if we have a credit sales, yes, we can say no problem, buy now and pay in 10 years.
Mm-hmm.
People may be really pleased to buy now and pay in 10 years. So our sale will go up, but what's happened? Our cash. So these type maybe the ratios not actually reflect your position of the business. So we need to be look around the future objective. We need to look around the company's uh, current policies, governance. We need to be look around economics environment, all other factor we need to be. Before COVID-19, financial statement looked wonderful. But during, because we're relying on the last year figures, maybe this year is totally different, and we are making decision based on the last year financial statements. Yes. So the ratios sometimes not reflect everything. So we need to be our own judgment, looking the future economics activities and what impact will be. Like if we in a housing or in the construction industry, until 31st, is it 31st July, stamp duty is exempt. Yes, maybe
Yes.
it's looking on the trend, but after what will be happen after that? Maybe the ratios not reflecting everything. Ratio reflecting is a good, yes, because the sale is going well in the construction and various other. So we need to be look around all other microeconomic factor as well.
Mm.
Okay. So we looking the ratios, four major we can categorize ratios into four categories. Liquidity, near to cash, anything which we can convert into cash or cash itself is called liquid. So current ratio, we have two ratios under liquid, current ratios and the quick ratio. Current ratio normally 2 to 1, £2 worth of asset and £1 worth of liability. So which shows £2 worth of asset, you have £1 worth of liability. Company is a sound liquid position, and we're looking only current asset, not non-current asset, which is mean short-term obligation and short-term asset. Quick ratios, then with inventory sometime is not most liquid. Inventory can be outdated, inventory can be obsolete, so that's why inventory we can take out. So according to this ratio, benchmark, normal benchmark, 1 to 1. £1 worth of asset, you can create £1 worth of liability. If you have a more asset, always good. Your liquid position will be good. Okay, then we have a financial position ratios, or we call gearing ratios. In profit, interest cover ratios, as many time our profit is higher than the finance cost, which is mean interest, always better. So we can compare with the previous year. Is it 10 times higher or is it 15 times higher? If the profit drop 2-3 times for the next year, still our loan is secure, we can get what we supposed to be in our return. Gearing ratio, as we know, the gear, if you drive a car in a high gear, high risk. So if your gearing ratio will come high, normally debt is cheaper than equity, but debt should be around 60% debt, 40% through equity financing. That's the best percentage. But if you go 80-90% debt, so it means 90% our company is owned by someone else and only 10%. And we are sometimes we say, oh, it's my house. But actually, it's not my house because I only pay 10% deposit. So 10% I have equity in a house. That's 90% is a bank house. How I can say is my house? Yes. So we need to think about and interpret these ratios, and then we can decide.
Okay. Question.
Yes, sure, please.
Looking at, we are trying to interpret these ratios. What is the standard? For instance, we know that for current ratio, it is 2 to 1. 2, the value of assets must be twice the value of liability. When it comes to gearing, when we come to interest cover, what is the standard?
Okay. Because it's depends, some industries are very less margin, like in a food industry. Yes. People say the return is a 400%. Yes. So if it's a profit, you're coming only 3 times higher than the interest cost, which is a very risky. If it's coming 10 times higher, yes, your profit against the finance cost, against the interest which we are paying, then it's mean is a less risk. And we all, if the time dropped, like last year our profit was 10 times higher than the finance cost, and this year we have only 4 times, which shows our company becoming more risky. So we compare. It can be look around, each industry have a different benchmark for it. Yes.
Right.
But normally more than 5 times your profit is a higher, which is a better. Huh? 5 times your profit is higher. than the finance cost, because finance is only interest element. Yeah. And when we're talking about gearing it's always good to be 60% or less. If it's more than that, it means we are becoming high risk. But depends industry, which industry we are talking. Some industry they work always borrowing, huh? They don't have. Think about maybe Amazon itself. Amazon, what they have? They have only few warehouse. Whose inventory they are holding? Yes, different sellers inventory there. So they don't really have equity. They have very little equity. So they more debt oriented organization, which is fine the way they are doing, but we need to think about, huh? Okay, next now.
How do we determine which benchmark apply to? We know that you have given a good example, Amazon, and there are other examples. For instance, a cow in the sales industry, maybe food industry. So how do we know? Assuming a customer comes to me now with the accounts, and I need to
You're absolutely right. When we can look around in that industry watchdog, what is saying about the forecast for the future? Yes, watchdog or regulator of the industry. Second, we can look around. If we look the Bitcoin, yes, what is a Bitcoin? Bitcoin is, of course, is going up, and many countries want to be regulate this. Yes. So the Bitcoin, so what we can look around when we look these ratios about Bitcoin, so we can look around what is happening in the micro environment about the Bitcoin. Yes. So more regulation means Bitcoin can go down. So maybe the ratio itself not put at the right direction, but the economics environment and the government policies will put us in the right direction.
Right. Okay.
Okay. Next, we're looking at the profitability and use of resources. Use of resources also known as efficiency ratios, to use other word. So when we're looking at the profitability ratios, we can maybe look around the return on capital employed profit from operation divided by equity plus non-current liability, because the non-current liability means long-term investment. That's why we borrow the money. Return on asset we can look around. Then we can look around return on equity. We can look around the gross profit margin. Gross profit, of course, we know the sales minus cost of sales equal to gross profit. So we can look around how many percent. It can be varies again industry to industry, but that gives you indication. If the last year, this year, gross profit margin drop, it means your cost of sales increase. You need to be think about to negotiate with the supplier or find more suppliers or use different supply chain. So that's which we can look around. Sorry, I think so someone's background noise. Is it I think so yours?
It's not mine. Let me check. I'm alone here.
Yes, I'll mute it. So you can unmute yourself if you want to speak. Okay, so next now, when we look the expense revenue, yes, we can look around specific like admin expense. How many percent my admin is going towards revenue? If my admin is coming 30-40%, is taking my or the IT expense. So what I can look around outsource, or I can look around how I can make it efficient. I can look around the same companies in the industry or my competitor, how many percent they have admin expense. So we need to be think about, and then we want to be reduce them. Okay, then these are all the profitability ratios and the use of resources. We can look around inventory turnover, how many times or how many days takes inventory convert and sell it. Trade receivable should be lower than the trade payable. Trade payable if it comes 60 days and trade receivable can be 30 days. So there should be a safety net. Okay, if any question you can ask, you can chat as well. So working capital cycle, inventory turnover days plus receivable turnover days minus payable, trade payable turnover days. So we can say this is one working capital cycle. Any question here? And then we can look around asset turnover as well. So all these ratios being summarized, and interpretation of these ratios is being discussed here, please. Okay. We all okay? Can we hear me? Yes?
Can I ask it?
Yes, sure, please. Yes, any question you can ask, please.
Yeah. Inventory ratio. Are we talking about how long we hold stock, or are we talking about how long how long it will take us to buy finished stock?
How long it takes to buy the stock or convert to finished goods and sell it? Inventory turnover, yes. We're talking about inventory turnover, yes?
Yeah.
So yes, so what we need to do, we need to make sure as a quicker is a better, huh?
Yeah.
Yes, converting and selling. That's why we use JIT, just in time. Our direct business model, our taking order advance, our changing our business model, such as the Dell computer. They move to assemble in India, taking order in advance and delivering in 21 days. So what do you think? Because you have a cash advance, you're producing in low cost area, yes, and we have a mode of communication, our mode of transport now is very fast, yes. DHL can deliver in 3 days, and we can assemble in 2 days, 1 days even, huh? So they give the time 21 days, maybe deliver in few days, yes, but depends on the circumstance. So that's all we need to look around. And now we have two companies. These handouts will be available on Moodle as well. I can show you which we'll use, and I use to compare two companies. We can compare real companies as well. We have a two companies. One is called Anika, one is called Papika. We've been given their financial statements, which is the profit and loss and the balance sheet. These are two statements crucial for ratio analysis for these. And we've been given assets and all bit and pieces. So then we use the formulas and we have calculated the ratios. So first ratios, we calculated the gross profit. So gross profit is 45% Anika and Papika is 52%. So if you look just gross profit, which one we think is a better? So Papika is, yes, is a better because it's a 52% return instead of. So that's 7% is a better. Let's we look other ratios. When we look the operating profit is Anika is 9%, but the Papika is 11%. So Papika has less operating expense. But how much percent was here difference? There was 7.5. And what's happened here on the operating profit between two companies? Here is a 2% difference. So in real sense, Papika has more operating expense. Yes?
Yes.
But Papika cost of sales is a lower compared to. That's why there is a difference of 2.5 still. So maybe as a Anika, if we are management of Anika, we can think about, we can compare with them. Okay, gearing ratio. We have a two formulas, debt plus debt. So this came 13 point and this is 71 point. So if we look the gearing, Paprika is very high risk company,
Yeah.
71%. So Paprika's own asset is only worth of 29%, or less than 28%, you can say. So Anika is less. So we learn in the business, higher the beta, higher the risk factor, higher the return. So which is a true example in Paprika. Paprika is a high risk company. You can earn the high return compared to Anika.
Yeah.
So we can interpret these according to our own decision, which area we are looking these ratios and what decision. Interest cover. So they have interest cover 11.6 times, and Paprika is only 3.1 times is a higher than the finance car. If you look the gearing, if you have a high gear, you borrow high money, you have a high interest, and your times will drop. But Anika, 11 times against the finance car, their profit is a higher. So Anika is a less risky than Paprika.
Yeah.
And asset test ratio is the liquidity ratio. We said it can be 1 to 1. They have 1.22. It means £1 and 22 pence of asset they have and £1 worth of liability they have. Current liability. So here in term of Paprika is only 65 pence worth of asset and £1 worth of liability. So Paprika is more risky than Anika. No, if somebody asks you recommend which company you will invest, so what you will say on the base of these?
I'll prefer Anika.
Anika, yes, which is fair enough, and you can say Paprika, like you want to be invest in Amazon or you want to invest in BP. BP maybe British Petroleum will give you very little return, but is IT companies, yes, can give you quick return, but it can be quick flop as well. So it's entirely up to you what sort of person or what really you want it. So we can measure the performance, yes, of these company, and we can see here, we can compare, but we not so just based on just ratios. We can say to investor, you can look around the future economics investment. If the housing sector, yes, this company, is it which industry? Yes, what are the economics indicators of that? Then you can, because otherwise your decision can be impact on value. So here we've been given the decision of this company. Like you very well said, Anika is a less risky. So if the in a list suggest me to invest in Anika instead of Paprika, yes, which is very well you said. So we can look around different users, we can look around what decision will impact of these ratios, or what is the company decision. Like we borrow money, but we borrow money to extend the factory and put the automated plant. Our liability went up, our return on capital employed this year is down, but what will be happen in future years? Because we have a automated machine, in future year our profit can go up. Yes. So you have to look around which industry and what is the demand of that product in that industry, not in the economic. So we have to look around. One is, you hopefully we all learn, pest or the pestle forces, yeah? Political, economic, social and technological environment, and link with which which company we are in, which industry we are in. Huh?
Mm-hmm.
Like if we are in a housing industry and the base rate at the moment, do we know base rate? UK base rate, please. Base rate, basic interest rate, what is that?
That's where I think is 0.25, 0.025.
You was right, but it dropped down to 1%, 0.01.
Oh, I'm not correct then.
So, what do you think? Due to this, we can get mortgage even less than 2%.
Yeah.
If you want to start your business, maybe you can get loan even 1.5%. Yes.
Yeah.
So, which is cost is dropping. So, economic activity can be boosted. But what is happening? Employment. How much is the unemployment rate we have at the moment? What do you think?
I don't know.
In UK unemployment?
I don't
Percentage.
know.
4.9?
So if we don't know, we can go on the website ONS. ONS is called Office of National Statistics .gov.uk where we can find the figures. Huh? So let's say our unemployment rate is went around 5 plus.
Yeah, it's 4.9%.
Yes. So we can say around, yes, 4.9. So here is also gray area because many people, they're not going to every week to sign in the job center. They can show few hours for work and they can claim that working tax credit. Yes. So they claiming the working tax credit, but they are count in the economy. They are employed by. So
Yes.
this unemployed figures is reducing, but it's not means they have everyone have the disposable income.
Yeah.
Yes. So we can look around. Like if we look per capita income of different, what do you think per capita income of UK? Anyone knows per capita income of UK?
No.
So we can use the website World Bank data per capita income of UK. So we have around $45,000.
Yeah.
So what this represents? Is it everyone is earning? No, it's not everyone earning. Around 37,000 pounds. Yes. So
Yeah.
we need to look around the distribution of wealth as well. Yes. How many millionaires? How many billionaires? So this COVID-19 made the people. Someone was 2 billion worth of assets, and they have now 25 billion worth of assets in the UK. Yes.
Yeah.
Because in crisis, which people can multiply even their wealth. Yes. By it means someone lose, someone gain. It's not mean everyone lose. Okay. So these are all the factors we can keep in mind when we make the decision and interpret the ratios, and then we can go ahead. Huh? So it's a good to be. You can download the financial statement. You can download even strategic corporate governance report. You can look around the CR report. You can look around strategic planning of that company, what is they think, what risk indicator they have, and what is the views about and details about the going concern. All these factors we also keep in mind, and we look at external factors. Okay. Anybody, any question? That's all from my side really today about. So that's our LO3. If you have any question, please drop me email or let me know
Yeah.
and ask. If you have question now, you can ask as well.
Okay.
So next lesson we'll go through our assignment discussion. We have a 3 hours.
Yeah.
Okay, thanks for attending today. Have a nice weekend and enjoy weather.
You too.
All right.
Thank you.
Thank you.
Bye.